History doesn't always repeat itself, but it sure does rhyme. In 1637, entire fortunes vanished over a tulip bulb. In 2000, trillions of dollars evaporated along with .com domain names. In 2008, the American dream turned into a debt nightmare as the housing market crumbled. And here we are, in the middle of 2026, looking at the sea of green on our screens and the relentless explosion of AI. Do you see the ghosts of the past starting to reappear? Today, we're peeling back the curtain on the darkest chapters in financial history to answer one question. Are we standing on the peak of a golden age, or are we teetering on the edge of a massive systemic bubble? First, let's talk about the sheer madness of tulip mania. In 17th century Holland, a single bulb was worth as much as a luxury mansion in Amsterdam. People were mortgaging their homes and selling their land just to trade a plant. But when the fever broke, they were left with nothing but compost. The lesson? When the price of an asset completely detaches from reality, a collapse isn't just possible, it's inevitable. Fast forward to the year 2000. The dot-com craze was in full swing. If your company had .com in its name, your valuation went to the moon, even if you hadn't turned a single cent in profit. Everyone believed the internet was a magic money tree that would never stop growing. It wasn't. The tech was real, but the delusion cost investors over $5 trillion in wiped-out market cap. Then came 2008, a different story of greed and toxic leverage. When risk was camouflaged by complex financial jargon, the entire system collapsed like a house of cards. What's the common thread here? Three dangerous words. This time's different. So what about 2026? Let's look at the cold, hard facts. First, the AI fever. We've been talking about it for 2 years straight. AI is a real revolution, no doubt. But ask yourself, how many companies are actually generating cold, hard cash from it? And how many are just AI washing their brand to pump their stock price? When expectations outpace actual revenue, you're looking at the textbook definition of a bubble. Second, emerging markets. With the big news of the Vietnam market upgrade this September, foreign capital is flooding in like a tidal wave. But watch out. When P/E ratios hit irrational levels and get-rich-quick groups pop up like mushrooms, that's when you need to keep a cool head. The red flags of a 2026 bubble are everywhere. 1. Amateurs are suddenly trading gurus giving out hot tips. 2. Margin debt, money borrowed to trade, is hitting record highs. 3. And the most dangerous sign, everyone believes the market can only go up. If you don't want to be the one left holding the bag, here's what you need to do right now. 1. Audit your portfolio. Dump the trash stocks that grew on nothing but hype. Stick to companies with real cash flow and low debt. 2. Keep a war chest. In investing, cash is king when panic hits. Never go all in at the top. 3. Set your exit strategy. Don't let greed drive the bus. It's better to take profits a little early than to watch your paper gains vanish into thin air overnight. History doesn't teach us to fear the market. It teaches us how to survive it. Don't let the crowd's euphoria cloud your judgment. Remember, the wealthiest people aren't those who won big during the hype, but those who were still standing when the dust settled. What's your take on the 2026 market? Is this a golden opportunity or a sophisticated trap? Drop your thoughts in the comments below. Don't forget to hit like and subscribe so we can navigate these financial waters together. Stay smart, stay invested, and I'll see you in the next one.